As you consider the solution for this supplemental NPV IRR model, there are really three major portions of it that bear some discussion as it relates to solving for the final answers. The first of which I believe that you need to pay attention to is the idea of setting up good assumptions. So notice that not only have I set up good assumptions, but I've tried to do my best to categorize them appropriately. For example, we start on the income statement related assumption, which again represent the operating cash flows that are going to drive the returns to the initial investment. So we've gone so far as to set it up to emulate the income statement so that you start by showing through all the periods, which are the 10 years that this project will last, that there is a demand-based data that's going to help you understand your memberships, and your memberships drive your revenues. Now notice that the data was presented in months, so I also have an assumption built in here for months. So now that you've got those basic operating cash inflows, the next major component is to follow along in the income statement and document the expenses that are associated. The cost of goods sold is driven by the number of teachers who will be teaching a certain number of classes, and then built into the expense model is the idea that those teachers will be compensated approximately 4% more every year as a growth in their base salaries. Beyond that, then you have all the administrative back end costs of operating expense, plus looks like we're doing some borrowing, and then always tax. So now you have your operating cash flows in and out, revenues and expenses. So now it's time to think a little bit about the statement of cash flows related expenses, which are really the investments that you're making in the original building and equipment that it'll take to run the dance studio. So those figures associated with the numbers that will help drive the depreciation calculations are also documented here. They're not extended the full 10 years like the numbers are above because these are one-time expenses and so only really need to be listed that once. Lastly, we have a discount rate assumption that's going to help us calculate our NPV. So now that you've got that laid out nicely, it should be fairly simple to make a finance-based approach to your income statement, whereby the revenues then that will occur in any given year are simply going to be equal to the number of patrons that you have multiplied by the number of months multiplied by then the membership fee per month. The cost of goods sold calculation is going to follow the same vein in terms of it's going to be the number of teachers that you have teaching a certain number of classes, getting paid a certain amount per class that they teach per month to round out our annual figures. Extending them throughout, the next major calculation to think about is that depreciation calculation, which references the aggregate initial investment that's laid out, that's then straight line depreciated using the appropriate salvage values over the course of the 10-year life of the investment. That then allows us to get ourselves to EBIT, we take off our interest, and we can get an EBT number, which we apply tax to, and now we can get some solid net income figures that are the baseline starting point for cash flows from operations. And the simplest proxy for cash flows from operations is to think about net income and then adding back the depreciation amount. So now that we know that we have these base cash flows, we can put them together on a simple NPV model, which once again is delineated over the course of those 10 months. The initial investment represents the purchase of the studio and all the equipment that is necessary. The correlating cash flow out that goes at the back end of that model is the idea that not only in the last year will you get a certain number of revenues, but you will also go ahead and sell back to the market a portion of those capital goods that will allow you to recoup a certain number of dollars in terms of cash flows in from investment. The inflows represent then simply all of the revenues, and then the outflows represent your four major categories. Costs that are related to producing the product, in this case it's teacher salaries, all of the back-end administration from utilities and insurance and whatnot, payments made to banks, also known as interest, and then payments made to the government, such as in taxes, and that represents then your ongoing cash flows from operations that you make out. Cash flows net is simply then the difference between cash flows in and out, and then it's to that number that we do our net present valuing by referencing the net cash flows at specific points in time using the discount rate that was applied so that you can get your present values. My approach to doing NPV is I like to first calculate all the present values and then simply add them up. The last line then we have on the spreadsheet for us is then the internal rate of return, where IRR uses as its inputs only those cash flow net figures that you put together on the model up above. When we do our baseline analysis then, we can see that the studio proffers a significant positive NPV, and that if we think in the context of the discount rate, whereas other projects of similar risk would ask or demand or offer a 12% return, in this case, this project looks to offer a 21-ish% return, which tells us that this would be a solid project to pursue.